Hey traders, Stephen Kowitzel here with thetradersplan.com. Today I'm going to show you how to use the VIX, the volatility index, to make investment decisions. So stay tuned. Okay, so right now we're looking at the VIX, we're looking at a chart of the volatility index, plus I have the S&P 500 down here. I'm just going to scroll down a little bit on the chart here so you can see it. It is July 21st, 2016 as I record this. So, I want to point a couple of very important levels on the volatility index that I have found just by observing that seem to be very critical. And the first level of the volatility index, now what that really is that is the fear gauge. That's what they call the fear gauge in the market. So when the volatility index is very high, there's a lot of fear in the index, in the market. And when the volatility is low, that means everybody's feeling great. The market's going to go up forever. And typically that's not the best time to put your money to work. So I'm just going to show you a couple quick samples and ideas for you. Right now, I've noticed that over time that the volatility index right around 12, right, when this fear gauge falls all the way down to 12, that's usually meaning everyone is feeling good about the market. The market, is just going to continue to keep chugging higher and higher and higher. Well, if it gets to that point, typically that's a good time for the market to take a pause and pull back. So what I've noticed is the volatility index really finds support at this 12 level. So if you see, and now this isn't an absolute exact science over years and years, but typically when it gets around this level, that just means everyone's feeling great, and that's typically not the best time, because when everyone's feeling great, that means the market's going to pull back. So you just want to be cautious. So for example, right now, the volatility index, it looked like it bottomed yesterday and is looking like it's finding support at this 12 area. And what that means, when the volatility finds support, that means the fear gauge is going to start rising, which means the market, now this is the S&P 500, is going to start pulling back. Now, just because the VIX finds support at 12 or around 12 does not mean that the market's going to roll over into a 2008 type of market. It just means that if the market hits this level, maybe you should wait for a pullback before putting more money to work. So you can see right here we had this reversing candle right here the day before. I believe this was yesterday, and then the market the VIX found support and is looking like it's raising about 7-8% today, so back above the 12 area, and in conjunction the market is rolling over. So if we look at a lot of these periods, and this is going all the way back before the market rolled over at you got the flash crash of 2015. But if we go back just a little bit, about a year, you can see that I drew two lines, and one line is at about the 17 level on the VIX, and one line is about the 12. It's okay for the VIX to be in between these areas, because the market does not go straight up. So it's not reasonable to expect for the VIX to stay under 12 for a very long period of time. So it's going to do some quick pullbacks. So what I did was I drew really this support and resistance line. If the VIX pinballs between 12 and 17, I would say that's okay. So if I drew a box right around here and then looked at this S&P 500, you can see from the time that it dropped back below 17, the market started to move higher. And even though it's not a straight line, they definitely don't make it easy for us, but the market seemed to be in pretty good shape. For the most part, it was moving slightly higher with some pullbacks. So you can see if the VIX is within this 12 to 17 area, I am okay. And you can look over here, you can see the VIX was between 12 and 17 right in this area. The market was moving higher. So as the VIX was moving lower, the market was moving higher. But look, right around here, as the VIX found support around 12.8, it was very close to the top. Everyone was feeling great. And then the market rolled over as the VIX was rising. So again, we look at that approximately 12 area as I wouldn't really call it euphoria, but as an area to be cautious, maybe take some profits, or at least maybe not make any new purchases until we get a pullback. Same thing over here. If you look at the VIX was between 12 and 17 as the market was topping in 2015. It finally broke above the 17 level, and then the market completely rolled over. Now, I would say when it starts to get above 17, I really start to pay attention. I would say 20 is really, really my cautious area, and we're going to look at a chart on that here in a minute. But if you learn anything from this, how to use the VIX, I would just say if the VIX, as a secondary indicator, if the VIX is around 12, that means everyone's feeling pretty good or pretty greedy. And maybe that's just the time to take a pause, take some profits, or at least hold off on any new purchases and wait for a pullback. Now, if the VIX, let me go to a different chart. Now, this is the VIX over approximately the same time frame, a little bit longer, but where the level that I really think is important to pay attention to on the VIX, when the VIX starts to spike, that means there is a lot of fear. That means there are a lot of people buying puts on the S&P 500. That 20 level is really worrisome to me. As a rule of thumb for myself, I'm not typically going to put any new money to work if the VIX is above 20, because I'm not trying to catch a falling knife. Now, I do like buying some pullbacks. I'm not against buying pullbacks, but from what I have found from my own research, just in the near term, I haven't looked at the last 100 years, but just over the last couple of years, it's typically when I have this line at 20, and then I have circled all the times that the market initially spiked above 20. And what I figured out is when that initial spikes happens, right, that's typically a lot of fear that comes into the market. That might be a very, very short-term bottom, but that's typically not the bottom. So you can see right here in June of 2016, the VIX hit above 20. Right, as the market pulled back, it tried to come back and take out this high, but then it rolled over. Okay, so that's telling you that first initial spike above 20 in the VIX was not the bottom. Same thing over here. We go back. The VIX initially spiked above 20 in November of 15, and you can see it was a short-term bottom. But then you can see the market tried to come back, and it could not take out the highs, and then completely rolled over. The S&P 500, which I'm calling the market, dropped 11% from the time the VIX breached the 20 level. Now over here, you can see the VIX breached the 20 level. It was a very short-term bottom, came back, the S&P tried to break 2 new highs, and then completely rolled over. The S&P dropped 9% from the time that VIX breached the 20 level. Now, when you go back a little bit further and you look over here, the VIX breached the 20. It looks like it fell about 3 or 4 more percent and then put in a real bottom. Same thing over here. The VIX hit 20 and then it continued to fall. So if you learn anything from this chart, that initial breach of the VIX of the 20, if it continues to fall, maybe there is there's a bottom that's about to be put in place. But if it immediately bounces, I would be cautious and make sure before you put all your capital back to work that the S&P 500 or whatever indice you are looking at continues to break out to new highs. So again, looking at really the 20 level as my rule of thumb, I don't put money to work if the VIX is above 20. I like to see that fear gauge come down a little bit because I've just seen time and time again that initial spike. Yes, it might have been a short-term low, but in the long term, you probably would have lost money here, lost money here, lost money here. You probably would have made money right here, probably would have made money right here, but either way, it wasn't the exact bottom. So 20 is an interesting level at the VIX to pay attention to, and if the VIX pulls down to 12, that's typically a good time maybe to take some profits or at least wait for a pullback, because when everyone's feeling good about the market, typically that's the time the market's going to roll over. So I hope this helps you using the VIX as a secondary indicator to make some short-term swing trades or some short-term investing decisions, or even some long-terms. So I hope this was helpful. If you're curious on what some of my top enter and exit strategies for stocks and ETFs are, stay tuned. Hey traders, this is Steven Kowitzel with thetradersplan.com. I hope you enjoyed my most recent video lesson. There's going to be many more to come. You know, I talk to traders all the time and they keep asking me the same thing. They say, Steven, I really need help timing when to get in a stock and when to get out of stock because I believe I'm losing money when I shouldn't be. So I designed and created the Savvy Trader course to really help you pinpoint with accuracy what is the best time to get in and out of a stock or an ETF that gives you the highest probability of success. And as a bonus video, I want to show you one quick trick. It's really, really easy to show you how to pick the exact bottom in a stock or an ETF. So click the button below or to the left or to the right of this video. I don't know where it's at. Just click it and get your free copy of the Savvy Trader course. I'll see you on the inside.